Welcome, everyone, and thank you very much for joining us today for this. We are delighted to have Tony Repanich with us. I'll introduce him more uh, formally in just a moment. Just a couple of housekeeping details. Tony and I actually have quite a bit to talk about today, and so. What we're going to have our dialogue, but if you have questions, there is please put them in the Q&A, and Tony and I plan on talking for about 45 minutes, and then we'll have an opportunity to address any questions you have in the remaining 15 or so minutes. I know many of you are know Tony well here. I know we've got a few. I know we've got a few fans of Tony and Shield here, and I'm one of them. Tony Repanich is the President and Chief Executive Officer of Shield Compliance, where he leads the company's strategic direction and serves as the principal architect of its compliance solutions. With over 30 years of experience in the financial services industry, including 2 decades as a senior executive at a Washington state-based community bank, Tony brings deep expertise in banking operations, regulatory compliance, and risk management. At Shield Compliance, he leverages this expertise to help financial institutions navigate the complex regulatory landscape of serving high-risk industries, including the legal cannabis industry. His leadership drives the development of purpose-built solutions that enable banks and credit unions to manage risk, streamline operations, and expand into high-growth markets. So, Tony, welcome aboard.
Well, Chris, thank you for that kind introduction, and good to get to work with you again in this new context. As probably many of our listeners today know, that you and I got an opportunity to work together when you were at a financial institution in Maine, and so great to get to work with you in this context.
Yeah, thanks so much, Tony. Just a few words about my background. I'm a former financial regulator. I was the attorney with the Maine Bureau of Financial Institutions for 6 years. And then in late 2014, I became general counsel at a credit union, community-based credit union in southern Maine, which had just started its I'll call them CRBs, community cannabis-related businesses, or cannabis banking program, which grew exponentially while I was there. And that's no, I take no credit for that. We just happen to be the only game in town. And then about a year and a half ago, I joined Cogent Law Group, and many on this panel or this group will be aware of the uh, uh, conference that's held down in Washington, D.C., the PBC conference. And I crossed paths with one of the partners there, and they were looking for an attorney with some experience with cannabis banking. So I have been with Cogent Law Group now for about a year and a half, and much of my work involves providing consultation services to banks and credit unions, either financial institutions who are looking to get started with the program, advising their board and senior management on the risks, those who already have a program but are looking to get into lending services, advising them on the risks, as well as helping draft documents, loan documents, policies and procedures, risk assessments. And then I also work with financial institutions that may have gotten into some trouble with their regulators and help them to remediate their program. So anyway, that's enough for the introductions. I'd kind of like to jump into our discussion points. And one of the first things I want to talk about with you, Tony, and I know you've got a lot of ins here, are what's going on the federal level regarding cannabis and cannabis banking. And I know that there are basically four talking points that I had on this. We had the Safer Banking Act, we had rescheduling the FinCEN guidance and 280E. Maybe we should just start with the Safer Banking Act and get that one over with. And Tony, I'll let you jump in.
Well, like many things in cannabis banking and the cannabis industry itself, it seems like there's a lot of Groundhog's Day, and so safer banking and its earlier iterations, safe banking, um, uh, continues to hang around, but I'm not very optimistic about us getting any movement on that. As many of you know, that safer banking really is a very narrow piece of legislation that is designed to provide a safe harbor for financial institutions as described in the Dodd-Frank Act. And so would allow them to basically, would it direct the agencies to provide specific guidance rather than, and rulemaking around exam procedures and things like that for serving this industry. And so that would be great for bankers. It would remove one piece of uncertainty from the equation, but most likely takes the practices that are in place today, and just codifies them. It doesn't necessarily simplify anything. Maybe we would get some relief on filing SARs on every single relationship every 90 days, but um, that's probably the biggest piece. Not even clear that safer banking would get Visa and MasterCard to participate. I know that their legal counsel had indicated they wanted to be specifically called out as the card brands rather than just being their financial institutions that they work with. So big picture is safer banking and its earlier iterations has passed the House, I think, 7 times. The House was under different leadership at that time. It has gotten through the Senate Banking Committee once. The makeup of the House has changed dramatically. Mike Johnson, not a big supporter of cannabis. So unless directed by the White House to advocate for this bill, I don't see Speaker Johnson having much motivation to bring the in. Um, if you look at sort of the political capital in the Senate, I don't think there's a lot of motivation there. People are trying to do things, but given some of the other battles that are going on around the budget, uh, I just don't see this being a priority or a place where people are spending political capital. I know the Cannabis Financial Roundtable is still continuing to advocate for passage of this bill as an incremental step towards normalization of the industry and to provide greater access to banking. The fact of the matter is, and Chris, you mentioned the FinCEN guidance, which has been around with us now since 2014. It's been reasserted by multiple administrations. It's really driving the industry, and it's really been the framework under which the 240 financial institutions that serve the industry actively today. I know those FinCEN numbers are higher about the people filing SARs, but remember, folks file SARs even when they're not actively banking the industry. You might have a random investor or a real estate property they've financed, but the people actually serving the industry, about 240. Um, that guidance is driving the underlying requirements for what it takes uh, to meet the regulatory requirements. And in fact, the regulators themselves, while they don't have published guidelines, um, they have a playbook, and they've used that playbook now to come into financial institutions, provide those examinations, and by and large, financial institutions are passing their exams even when they have cannabis. There's additional scrutiny, um, and um, and there is some discretion at the individual examiner level, as Chris knows. But there is the agencies are well versed in this now. In fact, in our portfolio of banks and credit unions that we work with, we have folks in every single charter type. So we have Fed member banks that are state chartered. We have state with the FDIC, federal credit unions, state credit unions. So the combination of charter types, including the OCC for national banks. So no examiner is immune from this today, and so there's an opportunity for many financial institutions to participate.
Yeah, thanks for that, Tony. And just going back to the Safer Banking Act, I remember back in my former incarnation crying wolf to my CEO and CFO when what was then safe banking was introduced into Congress, and it did look like it was gaining traction. It has been absolutely languishing in Congress now for 7, 8 years, and my eyewash is the same as yours, Tony. I don't hold out much hope for it. With all that's going on now in Washington, I think one can say most optimistically that it's just been pushed to the ground. I'm not even hearing much chatter about it, and so I continue to wait. When I did speak to my CEO about it, if it had passed, I think it would have represented some de-risking regarding the cannabis accounts. And everyone on this call knows that you price according to risk and time. And so the discussion I'd had way back when was, well, if this does get passed, might it be a reason to lower our fees? Anyway, that was all for naught. It never came to
Yeah.
pass.
Well, I
And
think the interesting thing about the safer banking and some of those conversations is, um, would that cause more banks to get in? And if you look at what we saw under Operation Choke Point and what that did to the money service business community and the businesses that are defined under that, there's still a limited set of financial institutions that participate in that market, given the enhanced due diligence. And there was no indication that if safer banking passed or safe banking, that we would get any reduction in the compliance requirements. And in most markets, I mean, Chris, you were in Maine. That's a wild market. We have an illicit market in the U.S. that is estimated still to be double the size of the legal market. So there was still going to be a high burden placed on financial institutions to sort out the good from the bad and to demonstrate that the transactions that they were participating in were coming from legal activity at the state level. The same thing that our bankers are doing today under the FinCEN guidance. So I think you're right. There would be a few more people that participate in the market. There that when we see new entrants in the market, that generally helps to bring down costs for the licensed operators. Um, but the work is still going to be there.
yeah, I think that's probably the most important point in all of this. As you mentioned, it basically codifies it will. I think there's a provision in there that will require regulators to put out the handbook,
Yep.
what the regulatory expectations are, and to further delineate what those expectations are. But as you say, all the filing requirements, the due diligence, beginning and ongoing, uh, will still be there. It basically just creates this legal safe harbor from prosecution. My own view on that is that it's not as big a deal as a lot of people make it out to be. I view the risks kind of in three categories. You've got the regulatory compliance risks, you've got the reputational risk, and then again, this sounds strange coming from an attorney, but my view, you've got the legal risk,
Right.
which is the smallest of those three categories, I believe. There has not been one financial institution that has been prosecuted for banking cannabis. We did have one consent to cease and desist with the Live Life credit union out in Michigan, I believe.
Yep.
But and we can talk about this a little bit more later in the conversation. I think it is a good reflection of how the regulators are looking at cannabis banking. And I would like to return to that subject. I know you've got some thoughts on that too. So that's
No,
a
yeah, go
really
ahead.
important thing to remember about the Safer Banking Act. Everything, the requirements will still all be there, and the services that you provide will continue to be there.
Yeah, you mentioned some other things at the federal regulatory level that we're tracking and rescheduling, of course, is a big there was a lot of momentum last year around the potential for rescheduling. And as I think most of our viewers know today that uh, this is a Schedule 1 on the Controlled Substances Act. It's deemed to have no medical benefit. completely criminal at the federal level, treated like heroin. So, it's bad news from Controlled Substances Act some point of view. Under rescheduling, which was directed under the uh, Biden administration, there's a whole administrative process for going through rescheduling, and which with HHS and DEA, and really this has gotten hung up with DEA and the courts. And we had hoped by the end of last year we would have gotten a decision on rescheduling, moving this from Schedule 1 to Schedule 3 and that got punted down the road here. The new DEA chief has indicated this is something he wants resolution to. Now, don't read that as he wants rescheduling to occur. He's pretty anti-cannabis. He just doesn't want to keep having to answer this question, probably when he goes to Congress. And so we may get some final determination on this. But what the rescheduling would do or would have done is put it on Schedule 3. Now, that has some benefits that are immediate. One is the potential to eliminate 280E provisions under the tax code. Today, under 280E of the IRS tax code, these businesses are treated as criminal enterprises, which means that when they go to file their federal tax returns, they are obligated to pay taxes on all of their revenue, and the only thing they're allowed to deduct is their cost of goods sold. So you think about a retail operation, while product might be 30% of your cost, you've got a lot of other operating costs and selling costs that cannot be deducted. So the effective tax rate for these operators is tremendous from a federal level. And so a few things that we saw there was that just sort of by luck, as you move from 1 to 3, you get out of that 280E provision. However, it does not solve the sort of the dispute between the federal government and the states about how these programs operate. If you look at Schedule 3 of the Controlled Substances Act, everything on that schedule, it requires a prescription and FDA manufacturing practices and DEA distribution practices. Most today in cannabis is adult use and doesn't meet any of the requirements. And so you would still have this challenge, I think, around financial services for the largest part of the market, which is adult use, and squaring that with the Controlled Substances Act. Remember, while the administration has the ability to determine where drugs fall on the Controlled Substances Act, they do not have the ability to redefine what it means to be in Schedule 3. And so that's an act of Congress. And we get back to safer banking and how things don't get done in Congress. So, so we would still have some of these same challenges that we're facing today. But that 280E provision would be huge for licensed operators. It would definitely increase bank balances because you'd have less money going out for federal taxes. And in most cases, when you have a tax cut, comes through Congress, has to go to the Congressional Budget Office, or for scoring around what the impact would be to the federal budget. This bypasses all of that. Now, people are recognizing in the congressional level that the potential for rescheduling could free up these 280E dollars. And there is a contingent of people in Congress that are trying to pass legislation that would not allow that 280 provision to be rescheduling so that the adverse taxation would continue to apply to the industry. And the likelihood of that getting passed, and it's very ironic, it's very conservative Republicans advocating for taxation, but we'll put that aside. It's there is a recognition there's a lot of money being made at the federal level from the cannabis industry, even though the feds still consider it illegal. I think that so 280E is probably not going to get resolved unless we have some rescheduling event, and there's probably not a lot of motivation in Congress to independently solve that problem. The one thing that we didn't talk about, Chris, and I was just at the CANRA, which is the National Association of Cannabis Regulators, last week. I would say that 50% of the discussion was around intoxicating hemp and the impact that that is having on one, licensed operators that these state regulators are responsible for, and they haven't, not only are they responsible for the oversight of these operators, But let's face it, they have a sales goal to raise a certain amount of taxes for their states with these cannabis programs, and these intoxicating hemp programs are cutting into that. So we're seeing legislation at the state, at many state levels, to put additional controls around intoxicating hemp. So that's really deriving THC from hemp under the Farm Bill of 2018, and then selling those products oftentimes across state lines. There's a big infused beverage market that's happening around intoxicating hemp. Some of the large operators are starting to get into that business because they just said, "We can't beat them, we're going to join them." So it's causing a lot of confusion. What we think from a federal level might happen is we might get the feds to step in on intoxicating hemp, most likely through the Farm Bill. But there's a lot of concerns about product safety, access for children to these products. Think of the old flavored vape days. You've got some of the same kind of concerns around some of these beverages, and just labeling and consistency. So the states are taking action right now, creating a lot of confusion, especially for bankers that also bank the hemp industry. But I think we may actually get some federal movement on that when the Farm Bill is re-upped, because that was a loophole in the Farm Bill from 2018.
Yeah, thanks for all that, Tony. And I agree with you regarding the rescheduling. I think it's stalled now with the new administration. And B, be careful what you wish for too, because I think it is going to invite an enormous, if the rulemaking were to proceed to final rulemaking, it would just invite a lot of confusion. I think what would happen is uh, as you said, it would have no effect on adult use. It only pertains to medical use, and it would only pertain to that subgroup of medical use that chose to become regulated by the Food and Drug Administration. So it really would apply to I think a fairly small subset, but it's not going forward as far as I can tell.
Chris, are you saying your main caregivers do not operate under FDA manufacturing requirements?
Yeah, as you mentioned before, Wild West, I think that was a
The
good
Wild East over there, I guess.
the
Yeah.
Wild East over here in Maine. Yeah, that's exactly right. We've got a we have a new administrator with the uh, cannabis policy folks, and I think he's finally sharing some wisdom with our state legislature on medical cannabis. Too little, too late, as far as I'm concerned, but better late than never.
Right.
So anyway, and as you mentioned, yeah, I think there are two Republican senators who are have introduced legislation to which would preclude the 280E getting cannabis out from under 280E, even if it were rescheduled. I think all of that is academic now anyway, because
Right.
it doesn't look like it's going to be rescheduled. So yeah, I think much like the Safer Banking Act, um, it's languishing out there. Not it hasn't been languishing as long as the Safer Banking Act, but languishing nevertheless. And then we've got as you mentioned, the Bible of cannabis banking, the FinCEN guidance, which is now about 11 and a half years old. And I know that there has been some criticism that it has not been updated, at least in legal circles. At the PBC conference 2, 3, 4 years ago, James Cole was he was the keynote speaker, and he very, very publicly lamented the fact that the Cole memo, which was used as the basis for the FinCEN guidance about 6 or 7 months later, created an unduly restrictive banking regime for him. And in spite of, his very own words on this, and I think pressure from others, FinCEN hasn't seen fit to update its guidance. And I'm not hearing anything to the contrary on that either.
Yeah, I would agree with you, and I think it's done. It's had it has had the intended consequence, I believe, of keeping illegal proceeds by and large out of financial institutions. Even if you look at some recent congressional testimony, they talk about bags of cash and all this unsafe stuff. That environment that they're describing is illegal operators. Today, legal operators in every state have access to financial institutions. Now, they may not like the price, they may not like the compliance requirements, but they do have an opportunity to be banked. And in many cases, they have multiple choices. And so the FinCEN guidance for its um, uh, gray areas, and some of it's sort of strange provisions, um, has provided an environment where these licensed operators can be banked. I still think where there's definitely a room for interpretation by the regulators is around these indirect, or sometimes what they're referred to as tier two or tier three. Most of that's in the footnotes of the actual guidance itself. And so we see that most bankers adopt a certain way of handling or defining those indirect. So those businesses that are receiving proceeds from cannabis operations but are not directly licensed or touching the plant and touching the plant. Um, but we still see variation there. Should I file a SAR? Should I file an initial SAR? No continuing SAR? How much enhanced due diligence do I need to do? It's very murky. And so that does open up, when you have uncertainty, that creates risk. And so it's making sure as a banker you have really well-defined policies and procedures. And what we do find is when you do have that examiner that's has their own thoughts about these things, that if you do have good rationale behind what you're doing, they may ask you to make a change, but generally that's on a go forward basis. What you're trying to avoid is for them to be able to claw back into the work you've already done.
Hmm. Yeah, and regarding the indirects, some of the FIs that I talk to who are kind of on the fence regarding cannabis banking at all, I do, suggest to them that foot in the door on this might be at least to um, allow for indirects, but you've got to define what an indirect is, and that definition has to be a reasonable one and a consistent one, and it has to be backed up by your due diligence. But I've always taken the view that if it's not a plant touching operation, the filing requirements don't exist. So that would take quite a bit of the burden, the compliance burden, away from the financial institution. Make no mistake, there's still risk
Yes.
uh, with those entities, and so pricing is appropriate. But that's always a good foot in the door, I think. I've always taken the view it's better to walk before you run, and I think in the cannabis banking space, it's good to crawl before you walk, and so that's one kind of a way in.
For sure.
I'd like to move on to cannabis lending now, if that's okay, Tony. Um, and I know that we're at a point now with there are enough financial institutions who are doing cannabis banking that they are looking at ways to distinguish themselves from their competitors. And I know when I was at our financial institution, I was getting calls on a regular basis about whether we'd be able to offer financing. And our board of directors, we went back and forth on it. We never quite got there when I was there. I'm not sure if they're now. But the FinCEN guidance, as many people on this call know, the FinCEN guidance doesn't really make the distinction between lending and depository services. It talks about financial services throughout. But having said that, there are additional risks associated with on the canna lending side. But maybe you could talk about that a little bit and how Shield compliance is able to mitigate those risks.
Yeah, I do agree with you, Chris. There are many financial institutions that are uh, looking at whether lending is right here, especially as we've seen fee compression on the deposit side as more There's more choices for licensed operators in terms of their banking. And so, how else can we create profitability around these relationships? And obviously, lending is one way to do that. No mistake, the industry itself, meaning the cannabis industry, desperately wants bank financing. When we do our annual survey of licensed operators, it's the number one reason they would change financial institutions is to get access to bank financing. We know today that most of the bank financing that occurs is real estate secured, but their financing needs go across sort of multiple asset categories. So not just commercial real estate, but they want operating credit to support accounts receivable financing, equipment purchases, unsecured credits. So, like any small or medium-sized business, they have lots of credit needs, and most of those are being fulfilled by the private market, not by the regulated financial institutions. Where regulated financial institutions have stepped in has been more often around commercial real estate. Generally, I think as community bankers and community credit unions, we do like dirt, so it's something we can touch, put our arms around. So just in general, we like that asset class better. But in this case, there's a hard asset to back up that loan. So when we get into commercial real estate, then what we're seeing is that about 60 to 70% of those borrowers are not the licensed operator themselves. They are uh, either a related entity, or more often than not, we're seeing individual investors who are saying, I'm going to buy a piece of real estate. I'm going to then lease it to a licensed operator. And the fact that on their rent rolls, they have that licensed operator providing revenue for that commercial real estate asset, that is then limiting where they can finance that property. So there's an opportunity there for banks and credit unions to provide financing on that property. In addition, we do see some licensed operators that directly own their facility and also want that financing. As you get into that individual asset, then you've got some particular challenges when you get into the cannabis industry. One is if you're trying to shore up this credit with any sort of credit guarantee, SBA, whether it's 7A or 504, or you're trying to look at some sort of USDA guarantee, those are not going to exist. Those are all federal programs. You're going to be prohibited from participating in those programs. So oftentimes when we have credits where we have borrowers with less history, we use those programs to help shore up credit risk. You got to kind of take that off the table. In addition, these properties, especially within that commercial real estate category, that investor category, usually generate outsized rents compared to another use for that property. And if you're using a cash flow approach to value that property, hey, it spins off this amount of revenue every year at this sort of discount rate, that would imply the property is worth X. You're going to inflate the value of the property given that inflated cash flow. So what most of our bankers are doing, the first thing they're looking at is how do I take the green premium out of this asset that I'm going to finance? And so then when I apply whatever loan to value that I'm comfortable with, I'm lending on the value in the event that I get this property back and it has to be used for alternative use. And so asking your appraiser to provide you with those kinds of comparables so that you can strip that green premium out. I was talking to a lender last week in the Midwest, who does quite a bit of these deals. He said his effective loan to value then comes in usually around 50% compared to the value that the customer has stated. So he's discounting his policy loan to value a little bit and then also discounting the individual properties based on that green premium. So that's one. Two, if in the event you get that property back as a banker, do you and let's say it's not the licensed operator who has that property, what do you want a building full of weed as another asset of the bank? And
Yep.
probably not. So looking at receivership and how you might um, structure your loan documents in the event of default. Remember, if your licensed operator themselves goes into default, they are not covered under federal bankruptcy. And so you're also then subject to the rules and provisions at the state level for how business dissolution or transfer of ownership should occur. So it's understanding that and baking some of those into your loan agreements. And that's going to be a state by state consideration. Two other things to consider. One is, remember, we talked about 280E and the impact that has on cash flow for these licensed operators. So understanding what that does to your debt service coverage. And so that often makes these transactions harder. So looking to look at global cash flow, what are the other assets and cash flow that these borrowers have when you look at the guarantors is beneficial. And then the last piece is commercial insurance. If something happens to this building, they're doing extraction, something that would cause damage to this asset that you've now taken as collateral, is it properly insured given the parties that are operating within the building? So, I'm sure on many commercial loans, you get your insurance information. It's pretty standard. I got a Starbucks in here. They've got their insurance, and it all looks good. We're gonna write up our loan agreement. You're really gonna want to understand that they've got viable insurance coverage in the event that something was to happen that would damage that property, especially from the activities of that licensed operator. So definitely some additional risk concerns. The benefit of taking these risks, however, is we're generally seeing for the same, all other credit risks being the same. So debt service coverage, um, at or better than your standard policy, loan to value at or better than your standard policy, personal guarantees on all of the transactions. You are then also getting anywhere between 150 and 300 basis point yield premium because this same borrower cannot go down the street to Bank of America and finance this property.
Yeah, those are all great insights, Tony. And I think I'm fair in saying that most of those kind of fall on the underwriting side. And it sounds like some of the folks you've been working with are pretty conservative on that side, very prudent
Yes.
when it comes to that, wisely so. I think some other considerations that you have to take into account are, from the regulatory side. I've always been a big believer that if you're going to get into the canna lending space, adopt what it's called a carrots for compliance approach. In other words, have them on the depository side for maybe two rounds of files, and then see how they're doing. Are they complying? Are they providing you with the information completely and in a timely way? Are they okay with the due diligence that you're doing and so forth? So that's one thing. I think also, in terms of your policies, you've got to uh, establish clear limits, both individual and overall limits. And I also think it's very important for financial institutions to establish a very clear approval process for these loans. Are they going to be made uh, just at the loan committee level, or do they need to go to the board first? For what amounts? Is it okay if you report, rather than getting board approval, which can be very cumbersome, but that you at least provide your board with specifics regarding the cannabis, the commercial loans that you're making. The collateral thing, I've always been a big proponent of a hard collateral. Just make sure it's not plant. That'll get you into a lot of trouble. And also, yeah, you mentioned the green premium, and in terms of valuing that collateral, I've been advising clients, value that collateral based on its non-cannabis use. I think that's the right approach.
One thing
Uh,
to also think about, Chris, in terms of, especially if you're lending directly to the licensed operator, is depending on the state that you're in, you may want to take that license as collateral. Now, that's not allowed in all states that they could
yeah.
pledge their license to collateral, so you really do need to understand that state's rules. But by and not necessarily that the bank would want to be, the operator of a cannabis business. But what it does do, especially if it's in a state where the cannabis license itself has more than $1 value. Like, it's not going to do you much good in Oklahoma or Oregon to take the license as collateral. But in a state where the license itself has value, it also prevents that licensed operator from going out and obtaining additional credit by pledging that license. Cash flow is a concern for the cannabis industry. Margins are tightening, taxation is high, compliance costs are high, and they're competing against an illegal market. So what we also see, so making sure that you kind of shore up that they're not taking out additional credit sort of after the fact that also eats into that cash flow, but then also understanding that these businesses, if they're in the earlier stages, looking at those projections they have, shocking those projections, and making sure that even if they were to cut their margins significantly, would they be able to service this debt? And so I think that's why many of our lenders, kind of to your discussion, Chris, earlier about do I want to provide deposit services to direct businesses or indirect? I think why many of our lenders start out doing what I would call indirect financing of the cannabis industry, which is, hey, I've got this commercial real estate owner who is separate from the cannabis enterprise themselves, may have their own substantial net worth that we can take as personal guarantee. And they are just being landlord for that licensed operator. Now, when you're landlord for that licensed operator, you're lending to that landlord, then you're going to want to make sure you understand where that business is banking and track some things about that individual business
Mhm.
if they're not banking with you, because ultimately the cash that your borrower is generating to pay back your loan is coming from that licensed operator.
Yeah, that's right, Tony. And you mentioned you talked earlier about the loan documentation too. And what I've seen with some of our FIs is that they're using their standard loan documentation, and really the loan documentation does need to be tailored. And I'm a proponent of a separate side agreement that's signed off by the borrower, just so that they are made very much aware of these specific provisions. I would include a bad boy clause, which would, give the financial institution the ability to call the loan if it were to find that it were significantly out of compliance. Choice of law and choice of venue, those are two really important provisions to have to consider in your loan documentation too. You're going to want it in pursuant to state law and pursuant to your state court where cannabis is legal.
Great
Um,
point.
and also, if you don't have a separate risk assessment for the can of lending side, you're gonna need one, or you're obviously going to want to expand that to include your can of lending. So that's some other considerations regarding can lending. I think you and I are both very much in agreement that you want to be pretty selective with your borrowers. Take the cream of the crop, but you've got a price nevertheless for your risk and all the additional time associated with can lending.
I just saw a stat last week, Chris, that there's $3 billion of loans coming due in the cannabis industry. I believe it's by the end of the first quarter of 2026. So I think we're going to see some, and many of those loans that because they were to companies that are publicly traded, maybe have like a Canadian public ownership. Uh, I think what you're going to see is a lot of trading of assets, a lot of looking for refinancing of assets in a much more difficult interest rate environment. And for some of these operators in a more challenging margin environment. So I think we're kind of keeping an eye on sort of what gets sorted out here because the benefits that were expected from a relief on 280E, as we discussed earlier, are not likely to come this year. And so that freeing up of cash flow will not occur. And so there's got to be some repositioning of these balance sheets around that debt.
Yeah, one of the things I neglected to mention about 280E, even though it doesn't look like it has any traction right now, is that it would have would have made your CRBs much more attractive borrowers.
For sure.
Cash flows would have been there and so forth. But unfortunately, doesn't look like that's going to happen at least anytime soon. I know we're already kind of running to the end, so I'm going to move on to
Yeah.
another topic here, cannabis banking inroads. And Tony, I'll let you take the lead. I know, there are things that banks are offering now, currency transport, smart safes. Even if they're not in the commercial lending space, they're offering personal loans to employees and owners. And as you mentioned, the compression in pricing, I think we're seeing more competitive pricing too. Anything you wanted to add to that, or?
Here's the advice that I'm providing bankers today. If you think about cannabis banking back when your credit union started it, or even in the 2018, 2019 period, a financial institution simply had to hang a shingle out that said cannabis banking, and they would have a line of customers. And I remember some of our earliest financial institutions we worked with would have a waiting list. Well, when the bank grows a certain amount, that will open up another tranche, or when if some customers leave or whatever happens, we'll have room for you. So you're on the waiting list. There are no waiting lists anymore. So if you are not yet in cannabis banking, and this is something that your institution is looking to pursue, then I think there's you should really consider then what is the value add that we're bringing to get these licensed operators. If there's a licensed operator in your state that doesn't have a bank account today, there's probably a reason for that. And so your best operators you're stealing away from another financial institution. Why would they come to you? And that's going to be that product set. What are you offering that's going to make their life better, more affordable? And so understanding where your value proposition is going to be for that prospective customer. Now, you do have states like New York and Ohio and Minnesota, where we've got lots of new licenses being minted, and that's a great opportunity to to get those businesses as they're making their initial banking decision. But in most markets, if you're coming into the market now, you're going just like any other commercial account, you're most likely having to steal them from somebody else. So why would they come to you? And so really have a very clear product and service vision, not simply that we have the risk appetite to do this business. Before, that's all you needed was the risk appetite. Now you need to have an actual product and sales strategy.
Yeah, I would agree with that entirely. Um, and what I've seen at some of the financial institutions I've worked with is that many times they have somebody in their department who came from the cannabis industry, who has kind of insider knowledge of the cannabis industry and can talk the talk and walk the walk with these CRBs. So there's some value add there too. Um,
Absolutely.
so anyway, we are running short of time. I'm gonna move on. Tony, one thing that I think is worth a discussion now is, attracting the right CRBs. And I think really what is it the financial institution, what are the financial institution's objectives here? Are they to increase their deposits, increase their non-interest income, their interest income? I think that's kind of a very, very important initial discussion to have, whether you're starting your CANA program or whether you're looking to expand it or changing to pivot in one way or the other. And just wondering if you had any thoughts on that.
Well, I think you're right, Chris. The financial institution has to be clearly grounded in the business motivations for getting into this. There will be bad days in cannabis banking. You'll have a regulator that's a little surly. You'll have a customer you have to fire because they didn't meet their compliance requirements. And somebody will go, "Why are we in this business?" And you're going to want to remember why you're in this business when you have that frustrating day. For most of our institutions, low cost deposits, especially in this expensive deposit market, is still the number one motivator. Fee income, number two, although that non-interest income is smaller than it used to be, but it is still outsized compared to regular commercial relationships. And then that's where lending has come in as an additional source. What we are also seeing is our bankers are creating partnerships around payroll and payments to be able to make referrals into those business and generate a recurring revenue stream back to the financial institution for making sure that business gets placed with a qualified service provider. And so that's been one of the things that continues to grow and evolve. So many of our bankers today have a payroll partnership, and that generates revenue for the financial institution, and you're taking good care of your customer in the meantime. So I think those are all things to think about in terms of the product and service offering. I will say that one thing you'll see on the balance side is overall balances, average balance contribution for these licensed operators is slightly on the decline. And that we can track mostly to the fact that new capital is not coming into the industry at the same pace it did back in 2019 and 2020 when we just saw just sort of exuberance around investing in these cannabis businesses. The the rationale has come back to these investments, and so that has slowed down the pace of investments. That's also what's accelerated the need or demand for bank financing because just taking capital at back then what was probably more favorable terms is just not there.
Yeah, great insights, Tony. Thanks for that. Um, I see that we are coming up to the end of our hour and that it looks like we have a few comments in our chat. Let me just take a look to see what we have. Okay, let me just see here. We've got a question here. Yeah, so somebody has just commented that they've got a very successful lending program and that they do require an operating account after that they have the documentation that we need. I've always been a proponent of making it or mandating that if the CRB is wants an account with you, that your financial institution be the primary depository financial institution. And I think that's good from a business point of view, but I also think it's important from a compliance point of view too, because you can see firsthand through your core, what the cash flows are, what the how the business is trending and so forth. So I think there's nothing stopping you from making that requirement. Now, from a CRB perspective, many of them, do have a desire to diversify because of the fact that they don't want to have their FI end up being their last boyfriend or girlfriend. And so they do want an existing another choice in the event that that were to occur. So that might be a negotiating point with your CRB, but certainly something worth considering.
I think one other thing we saw related to that, Chris, was after the First Republic, Silicon Valley failures for some of the larger single state operators or multi-state operators, where the management team has obligations, fiduciary responsibility basically back to the investors. Some of them had fairly healthy balances at very small institutions. And so we did see some financial institutions lighten on that requirement about being the primary account. So there became more of a distinction at times between being the primary operating account versus the excess, where they might park excess liquidity. So, hey, Mr. Operator, we'll be your primary operating account. We're going to take all that money in, we're going to vet it, do the reporting. We understand you may need to move some of that to XYZ bank as excess liquidity because you have concentration requirements sort of for your investors to as a good management team.
Yeah, no, that's a great point, Tony. The same person has made comment that credit scores come into play as most in the industry haven't had a banking access. Another great point, and another reason why I kind of am a proponent of this carrots for compliance approach. See how they're doing not only from on the compliance side, but also, what their cash flows are, what their deposits are like, as you're monitoring the accounts and filing on the accounts. So, maybe wait 6 months. I would also add that, a carrots for compliance approach is something that the regulators would look upon very favorably. You're basically incentivizing good compliance by offering them the prospect of being a trusted financial partner on the lending side.
Absolutely. I
Yeah.
couldn't say it better.
Yeah, so we've got another comment here. What about energy? Growers use lots of it. What challenges do growers face contracting for energy? So it's a really interesting question. Again, I always look at these things first from a compliance perspective, and I do know that when we were monitoring accounts, we would see some accounts with very, very high energy bills, which
Right.
was kind of a red flag for us that perhaps they were an undeclared CRB with us. Uh, but and it goes on, I assume they often have to provide financial assurance and that it's difficult for them to get lines of credit. Yeah, I mean that's I guess my only comment to that is yet another very compelling reason why a financial institution might consider getting into the lending space. There are financing needs, and this is just one very, very good example of one.
Yeah, and I would say our bankers haven't had to deal specifically with some of that. We know licensed operators have challenges with that, but has directly bankers. I will say some really interesting projects like cogen facilities where we've got some other business operating on a facility that's generating excess power that would normally go back to the grid or something, and then leveraging that low cost power. I've seen some interesting projects like in Michigan for that. So I think that leads back to if you look both at the credit scores, credit history, that's why I think a lot of our lenders start on the side of, hey, maybe we'll lend to investors first who then want to lease to these licensed operators because they might be working on these cogen kinds of facilities. They will have credit scores. They will have outside liquidity. Um, Makes the underwriting a little bit easier as you get comfortable with the industry, especially if you have a very limited bucket of funds available to serve this industry.
Mhm. And then we've got another great comment from Ryan. I'm not going to comment on it myself. I'm just going to read it because I think it's worth reading out. Regarding valuations, he says, ask the appraiser for standard market as is and perhaps add as completed value. Most appraisers in a seasoned adult rec or MM state can add a cannabis value as well. So you have a well-rounded value to consider. I think that's very well heated.
Absolutely. Well, Chris, I know we're coming up on the end of our time, and you've been so nice to always support Shield and what we do, but I also want to put in a plug for the work that you do. And I know you've worked with a number of our clients on helping them as they evaluate their programs and look to add additional products and services. And so appreciate the help that you've provided them in analyzing that risk and some of the legal considerations that go along with that.
Well, Tony, I could not speak more highly of Shield compliance. And I speak from personal experience in my former role. You were great to work with, and we really appreciated all the help from your team. And I want to thank everyone for joining. And our Tony's and my details are on that last slide there. I kind of take pride on providing quick feedback, being available for folks. So if you have any follow-up questions, please do not hesitate to contact either one of us. And Tony, thank you again for joining us.
Thank you so much. Have a great rest of the day, everyone.
Yeah, thanks everyone.